On January 23, 2026, silver shattered the $100 ceiling. The exodus has begun. Most people believe silver is just an industrial metal, something for solar panels and circuit boards, a commodity that follows supply and demand like corn or copper. They are wrong. You see, silver is the canary in the coal mine for a $1.8 trillion debt bomb that detonates this year. And while the headlines celebrated a price rally, the forensic data tells a different story. The vault is draining, the paper market is fracturing, and the banks are running out of tricks. Today, I'm breaking down the three-stage mechanism that connects the commercial real estate maturity wall to the silver exodus. Stage 1, the refinancing trap. Stage 2, the COMEX autopsy. And Stage 3, the historical pattern that has destroyed 3 empires before us. By the end, you'll understand why the January 23rd breakout wasn't a rally. It was a warning shot. A mandatory protocol before we open the file. This is not financial advice. I'm not a licensed advisor. The math follows a script, but your capital is your responsibility. Always conduct your own research. Let's start with the debt bomb no one is watching. Right now, $1.8 trillion in commercial real estate debt is hitting what's called the maturity wall. This is not a prediction. This is a calendar event. Here's how the trap works. Between 2024 and 2027, roughly 60% of all outstanding CRE loans reach maturity, which means property owners who borrowed cheap money during the zero-interest era now have to refinance at rates that are 3 to 4 times higher. The math is no longer sustainable. A landlord who borrowed at 3% in 2019 now faces refinancing at 7 to 9%. Monthly debt service doubles. Cash flow evaporates. And if the property can't cover the payment, the borrower has 2 options: inject fresh capital or default. Most can't inject capital. Office vacancy rates in major metro areas are hovering near 20%. Remote work gutted demand. Valuations have collapsed by 30 to 40% in some markets, which means defaults are inevitable. And here's where silver enters the equation. You see, the banks holding this $1.8 trillion exposure are the same institutions that control the COMEX futures market. JP Morgan, Bank of America, Citigroup. They are legally allowed to sell paper contracts for silver they do not own. This creates artificial supply. It suppresses the price, and it maintains the illusion that the dollar is stable, but there's a problem. Physical silver is decoupling from the paper price. Right now, if you want to buy actual metal, bars you can hold in your hand, you're paying a 50% premium over the spot price listed on financial websites. Dealers are quoting $35 to $40 per ounce when the paper market says $28. This is not normal. This is a liquidity crisis, disguised as a supply chain issue. The banks need the paper price low to protect the dollar's credibility. But the physical market is rejecting the illusion. Buyers are demanding delivery, and the registered inventories at COMEX are draining at a rate that cannot be sustained. Plus, the timing is mathematical. The CRE maturity wall peaks in the fourth quarter of 2026. That's exactly when the physical silver shortage reaches critical mass. The banks will face a choice: defend the dollar or defend the vault. They can't do both. Here's why this matters to your wealth. If you own silver ETFs or futures contracts, you don't own metal. You own a promise. And under Title II of the Dodd-Frank Act, those promises can be legally converted into bank equity during a systemic crisis. Your claim gets subordinated. The bank survives. You get restructured. Which means paper silver is a trap disguised as an investment. The only protection is physical custody, metal in your hand, outside the banking system, beyond the reach of the fine print. Now, if this specific mechanism just clicked for you, or you want to track these maturity wall shifts as they happen, join the Forensic Circle by hitting subscribe. Most people will wait for the evening news to tell them what happened. But by then, the exit will be closed. Let's move to the deep dive. Let's open the vault. The COMEX is the Chicago Mercantile Exchange. It's the primary marketplace where silver futures contracts are traded. Banks, hedge funds, institutional players, they all use COMEX to set the global price of silver. But here's the mechanism most people don't understand. COMEX operates on 2 inventory categories: eligible and registered. Eligible silver is metal stored in the vault, but it's not available for delivery. It belongs to private holders who are simply using COMEX as a warehouse. Registered silver is metal that's available for immediate delivery against futures contracts. This is the only inventory that matters. This is the metal that backs the paper promises. And the registered inventory is collapsing. As of the most recent data, COMEX registered silver sits at roughly 418 million ounces. That's the lowest level in decades. Now, let's put that number in context. Global industrial demand for silver is approximately 1 billion ounces per year. Solar panels, electronics, medical equipment. That's baseline consumption. It doesn't include investment demand. It does not include the physical buyers who are now paying 50% premiums to bypass the paper market. which means 418 million ounces is less than 5 months of global demand. But here's where the math becomes a smoking gun. The total open interest in COMEX silver futures contracts represents claims on roughly 1.2 billion ounces of silver. That's the paper promise. But the registered vault only holds 418 million ounces. You see the problem. The leverage ratio is nearly 3 to 1. For every ounce of physical silver in the registered vault, there are 3 paper claims against it. This is not a market. This is a Ponzi scheme backed by the assumption that no one will demand delivery at the same time. Plus, the drain is accelerating. Between December 2025 and January 2026, registered silver inventories dropped by 47 million ounces. That's an 11% decline in 6 weeks. The vault is hemorrhaging metal, and the banks are running out of room to maneuver. Now let's talk about what happens when the music stops. Most people believe their silver ETFs are safe. They believe that owning shares in an exchange-traded fund like SLV or SIVR is the same as owning metal. They are wrong. You see, under Title II of the Dodd-Frank Act, specifically the Orderly Liquidation Authority, financial institutions can be placed into receivership during a systemic crisis. And when that happens, paper assets held by unsecured creditors can be legally converted into bank equity to absorb losses. This is called a bail-in. Here's how it works. In a traditional bankruptcy, depositors and creditors stand in line to recover their funds. Secured creditors get paid first. Unsecured creditors get whatever is left. Equity holders get wiped out. But under Dodd-Frank Title II, the government can skip the bankruptcy process entirely. The FDIC steps in. The institution gets restructured, and unsecured claims, including your ETF shares, get converted into stock in the restructured entity. You don't get your money back, you don't get your metal, you get shares in a bank that just failed, which means your silver ETF is not a claim on silver. It's a claim on a promise made by an institution that can legally break that promise to save itself. The law is already written. The mechanism is already in place. The only question is when it gets triggered. And we just got a preview. On January 26th, 2026, gold hit $5,111 per ounce. Silver followed, spiking to $109 in a single trading session. This wasn't a rally. This was a short squeeze on physical reality. Here's what happened. Large institutional buyers began demanding physical delivery on their futures contracts. The shorts, the banks that sold paper contracts without owning the metal, scrambled to cover their positions. They went to the spot market to buy physical silver, but the physical market was already tight. Premium spiked, supply vanished, and the price exploded. Gold moved 7% in one day. Silver moved 15%. These are not normal market movements. These are panic movements, the kind you see when a systemic illusion fractures under pressure. The COMEX responded by raising margin requirements. This forced smaller players to liquidate positions. The price retreated. The media called it a correction. But the forensic data tells a different story. The registered vault inventory didn't recover. The physical premium didn't collapse. And the drain continued, which means the January 26th flash was not the end. It was the opening act. Let's frame this for your portfolio. If you own physical silver in your possession, you own an asset outside the banking system. It cannot be rehypothecated. It cannot be converted into equity. It cannot be seized under Title II. If you own paper silver, ETFs, futures, or unallocated accounts, you own a legal claim that ranks below the bank's survival. The law is clear. The vault is empty, and the leverage is unsustainable. Here's the mechanism in plain language. When the next systemic event triggers, whether it's the CRE maturity wall, a sovereign debt crisis, or a derivatives blow-up, the banks will prioritize their own survival. Title II gives them the legal framework to convert your paper claims into worthless equity. You will not be notified in advance. You will not have time to exit. By the time you see the headlines, the restructuring will be complete. This is not speculation. This is the script. Now, here's the part most people miss. The drain is not random. The timing is not accidental. The CRE maturity wall peaks in the fourth quarter of 2026. The BRICS summit is scheduled for late 2026. And the COMEX vault is draining at a rate that mathematically exhausts registered inventory by mid-2027. These timelines are converging. The system is not designed to survive all three events simultaneously. One of them breaks the illusion. And when it does, the physical metal becomes the only claim that matters. The banks know this. That's why they're suppressing the paper price. That's why they're raising margin requirements. That's why they're using futures contracts to create the illusion of supply. But the physical market is rejecting the script. Buyers are bypassing COMEX entirely. Premiums are 50% above spot. Delivery delays are stretching to 6 weeks, and the registered vault is bleeding metal faster than it can be replenished. The exit is narrowing. So here's the forensic question you need to answer. Do you own the metal or do you own the promise? Because when the vault goes to zero, the promise becomes a legal claim on nothing. The law is signed, the drain is accelerating, and the January 26th flash just proved the system cannot handle physical demand. But even this COMEX collapse is a symptom of a deeper pattern, a historical cycle that has destroyed 3 empires before us. And right now, the United States is following the exact same script. This is not the first time silver has been weaponized against the public. On February 12, 1873, the United States Congress passed the Coinage Act. The official narrative called it a routine update to modernize the monetary system. The forensic reality was different. The Coinage Act demonetized silver. It removed silver from the list of metals that could be freely coined into legal tender. Overnight, the United States shifted to a pure gold standard, which means the supply of money contracted. Debts became harder to service. Deflation crushed farmers and workers who relied on silver-based currency, and wealth concentrated in the hands of gold holders and creditors. This event became known as the crime of 1873. Here's why it matters today. You see, the demonetization of silver was not an accident. It was a deliberate policy choice designed to protect creditor interests at the expense of debtors. The bankers wanted a hard money system tied to gold. Silver was too abundant, too accessible, too difficult to control. So they removed it from the system. The result was predictable. Populist movements erupted. William Jennings Bryan gave his famous Cross of Gold speech in 1896, demanding the return of silver coinage. But the bankers had already won. The gold standard remained in place until 1971. And now, history is rhyming. The paper-silver market is the modern equivalent of the Coinage Act. Banks have created an artificial system where physical silver is suppressed through futures contracts and leverage. The metal is abundant. The demand is real. But the price is controlled by institutions that benefit from its suppression. Plus, the timing is mathematical. Just as the crime of 1873 preceded decades of wealth concentration and imperial overreach, the current silver suppression is occurring at the exact moment the United States enters stage 5 of the imperial collapse cycle. Now let's talk about the pattern. There is a 7-stage cycle that has destroyed every empire in recorded history. Spain, Britain, the Soviet Union, and now, here are the stages. Stage 1, monetary expansion. The empire prints currency to fund wars, infrastructure, or social programs. Debt grows faster than GDP. Stage 2, asset bubbles. Cheap money floods into real estate, stocks, and speculative ventures. Wealth appears to multiply, but it's an illusion backed by leverage. Stage 3, peak inequality. The wealth gap between creditors and debtors becomes unsustainable. The middle class shrinks. Social cohesion fractures. Stage 4, currency debasement. The empire can no longer service its debts through growth, so it debases the currency. Inflation accelerates. Trust erodes. Stage 5, decoupling from reality. The paper currency separates from physical assets. Gold and silver premiums spike. Citizens lose faith in the monetary unit. Stage 6, social chaos, protests, strikes, political extremism. The empire turns authoritarian to maintain control. Stage 7, collapse. The currency fails. The empire fragments. A new reserve system emerges. The United States is currently at stage 5. Here's the evidence. The federal debt is $36 trillion. That's 120% of GDP. Debt service costs now exceed defense spending. The only way to sustain this is through monetary expansion, which means the dollar is being debased in real time, but the decoupling has already begun. Physical gold is trading at $5,000 per ounce. Physical silver is trading at a 50% premium over paper spot. And the vault inventories at COMEX are collapsing. The market is rejecting the illusion. This is not unique to the United States. Spain followed the same pattern in the 1590s. They imported gold and silver from the New World, debased their currency to fund wars, and collapsed into irrelevance within a century. Britain followed the same pattern in the 1920s. They printed pounds to fund World War I, lost the gold standard in 1931, and surrendered their reserve currency to the United States by 1944. The Soviet Union followed the same pattern in the 1980s. They printed rubles to fund the arms race, lost credibility in international markets, and collapsed in 1991. The math does not care about exceptionalism. The cycle does not respect ideology. And the United States is not exempt. Stage 6 is the mathematical next step. Now let's talk about the catalyst. The BRICS nations, Brazil, Russia, India, China, and South Africa, are building an alternative monetary system. This is not a rumor. This is not a conspiracy theory. This is a documented policy initiative scheduled to launch in late 2026 or early 2027. The BRICS digital unit. Here's how it works. The unit will be backed by a basket of commodities: gold, silver, oil, rare earths. Each BRICS member contributes physical reserves to the system. Transactions settle outside the SWIFT network, and the dollar becomes optional for international trade. This is the final nail in the petrodollar coffin. You see, the petrodollar system was established in 1974. The United States made a deal with Saudi Arabia. Oil would be priced exclusively in dollars. In exchange, the U.S. would provide military protection and purchase Saudi debt. This created artificial demand for dollars. Every nation that wanted oil had to hold dollars. The U.S. could print currency without inflation because the world needed dollars to buy energy. But the system only works if oil remains denominated in dollars. That agreement is fracturing. Saudi Arabia is now accepting yuan for oil sales to China. Russia is selling energy in rubles and gold. Iran is bypassing SWIFT entirely. And the BRICS summit scheduled for 2026 will formalize the alternative, which means the structural demand for dollars is collapsing. Plus, silver is the key component of the BRICS unit. The digital infrastructure requires silver for solar energy. Data centers, electric grids, and the physical backing of the commodity basket ensures the unit has intrinsic value unlike fiat currency. This is why the silver drain matters. The BRICS nations are accumulating physical metal to back their system. The West is suppressing paper prices to defend the dollar, and the COMEX vault is the battlefield. When the vault goes to zero, the paper market collapses. The dollar loses its last illusion of stability, and the reserve currency shifts east. Here's the timeline. The CRE maturity wall peaks in Q4 2026. The BRICS summit is scheduled for late 2026. The COMEX registered inventory is draining at a rate that exhausts supply by mid-2027. These are not isolated events. These are converging timelines that mathematically guarantee a systemic break. Stage 5 is accelerating. Stage 6 is inevitable. And the only hedge is physical assets outside the banking system. The crime of 1873 took 30 years to trigger a populist rebellion. The current silver suppression is happening in real time. The vault is empty, the East is ready. And the math does not forgive empires that ignore the pattern. So here's the forensic conclusion. The vault is empty, the law is signed, and the only question left is whether you understand the difference between ownership and entitlement. Most people will wait for the evening news to tell them what happened, but by then, the exit will be closed. You see, the 2026 script is moving faster than the headlines, the CRE maturity wall, the COMEX drain, the BRICS launch. These timelines are converging in real time, and the institutions that control the narrative have zero incentive to warn you before the restructuring begins, which means you need access to the forensic data as it develops. If you're the type of person who refuses to be a victim of the script, join the forensic circle. Subscribe. We hold ourselves to a different standard here. No hype, no speculation, just the math, the law, and the historical pattern. Plus, there's another mechanism I haven't covered yet. UCC Article 8, the security entitlements loophole. This is the legal framework that determines whether you actually own your stocks, bonds, and metal, or whether you just own a claim on a custodian's promise. I'm writing a full autopsy on that right now. Make sure you're subscribed so you don't miss the reveal when it drops. Here's the forensic conclusion. The vault is empty, the law is signed. The January 2026 price spike was not a rally, it was a warning shot. The real maturity wall hit occurs in the fourth quarter, and when it does, the only question that will matter is whether you own the metal or just the promise of it. Because promises can be restructured, promises can be converted, promises can be subordinated under Title II. But metal in your hand cannot be rehypothecated. It cannot be leveraged. It cannot be seized by a failing institution desperate to survive. The cycle does not forgive those who confuse paper with ownership. The script has been written, the stage is set, and history does not wait for permission.